When you think of an IRS agent, you might imagine a serious-looking man monitoring your finances and preparing to audit you into the middle of next week. But what if payment apps like Venmo and PayPal were being turned into pseudo-IRS agents instead? After Trump's One Big Beautiful Bill reverted a $600 reporting threshold for payment apps back to $20,000, people assumed that surveillance overreach had been avoided. But the infrastructure has been built, and it's capable of detailed visibility into your transactions. So in this video, we're looking at what happened in this saga that has caused so much confusion, what systems have been built, and what this means for the future of everyday people. My name is Guy, and you're watching Coin Bureau Finance. First up though, I must make one thing clear. I am not a financial advisor and nothing in this video should be considered financial advice. This is our take on how financial surveillance is shifting as we speak. And if you want to see more stuff like this, hit those like and subscribe buttons and flick that notification bell too so you don't miss the next video. Alright then, let's start by looking at exactly why everyone was freaking out about that $600 number not so long ago and why there's still so much confusion around this issue. Now, the confusion didn't come from TikTok hysteria. It came instead from an actual policy push to drag a lot more small money transactions into the formal reporting world. So, here's what happened. Historically, third-party payment platforms generally only had to send you and the IRS something called a Form 1099-K once you crossed the old bar for commercial transactions, $20,000 and more than 200 transactions. The American Rescue Plan of 2021 then changed the trigger so reporting could kick in at $600 in payments for goods or services with no minimum transaction count. That didn't invent a new tax liability or anything, it just lowered the reporting threshold. And reporting is the part that changes everything. That's why the panic spread so fast. People heard the $600 figure and assumed it meant, if my roommate pays me back for utilities, the IRS is coming for my leftovers. That is not how it should work. Personal transfers like gifts or reimbursements aren't taxable income and shouldn't be reported on that 1099-K form. But of course, the problem is that real life is chaotic and apps don't understand intent. They understand categories and toggles. So, when policy met reality, the rollout face-planted. In late 2022, right before the first filing season when this was supposed to hit, the IRS delayed the $600 reporting requirement. This was in response to widespread concern that millions of people would get forms for things that weren't income in the first place. Then in 2023, it got delayed again. The IRS said it was trying to reduce confusion and laid out a transition plan that used a higher $5,000 threshold for the next step instead of dropping straight to $600. But ultimately, due to Trump's One Big Beautiful Bill, reporting for 2025 reverted back to the old $20,000 threshold and 200 plus transactions. Now, here's the important part for the bigger story. Delays, messy rollouts, and confusion didn't mean the idea died. Even while implementation got delayed, the compliance machinery inside apps kept getting built and standardized, and that's the part that's hard to unwind. Because while everyone argued about whether the number was $600, $5,000, or any other figure, the surveillance machine still got built. Platforms finalized the workflows, the systems to store and share information, and the UX herding that makes the whole system work. In other words, the infrastructure got set up. And once infrastructure like this exists, it doesn't uninstall itself just because it's causing confusion and some, or indeed many, people don't like it. As mentioned, in 2025, the threshold was ultimately reinstated back to $20,000 and 200 transactions, retroactively. That sounds like a win for anyone who doesn't want every element of their financial life to become visible to government bodies. But it doesn't change the deeper point. You can roll back a threshold on paper, but you can't unbuild the reporting infrastructure that was already tested, normalized, and left sitting there ready for the next adjustment. Now, if you open a payment app, you'll see something to the effect of a tiny fork in the road that looks like friends and family on one side and goods and services on the other. If you tap that second option, the app will suddenly start asking for your tax details and whether you're basically running a micro business from your phone. So, what's that all about? Well, one major reason that toggle exists: classification. The IRS treats payment apps and online marketplaces as, quote, third-party settlement organizations. So they're required to issue that 1099-K form to report payments you received for goods or services, and they file a matching copy with the IRS. Once that happens, your tax return isn't just about what you declare, it's whether your story matches the IRS's spreadsheet. To make reporting possible at scale, platforms have to push everyone into cleaner categories. Money sent between family and friends that's not for goods or services shouldn't show up on a 1099-K. Great in theory. But in practice, one missed tap and your harmless reimbursement can start looking like revenue. But we already established that the limit is back to the $20,000 threshold, so what's the issue? Well, that's at the federal level. But individual states can set out lower reporting thresholds. So even if the federal rule gets softened, your state rules can keep the reporting machine monitoring your transactions. And what do you know? Several states are just going with that original $600 limit. For example, Massachusetts, Virginia, and Maryland each use that $600 threshold that everyone freaked out about not so long ago. Illinois settled on a $1,000 level and 4 or more transactions. So, having a particular address on file changes what gets reported. It also means people have accepted financial surveillance at levels far lower than the federal threshold. And in addition to all of this, we have the identity layer. When the rules initially tightened in 2022, payment platforms told users to confirm their tax information to keep accepting goods and services payments. That's regulation that kind of turns these platforms into pseudo-IRS agents. And once the system can flip between different rule sets with comprehensive identities mapped out, it becomes durable and changeable. Historically, these systems only tend to expand, even if there are occasional rollbacks, because the infrastructure makes expansion easier next time. Because reporting is already different depending on which state you're in, the dial on who gets reported is already built into the app's back end. And that's the point. The government doesn't need dramatic crackdowns when it can make finances legible by default. So, needless to say, it's important to stay well informed on developments here. And if you want a convenient way to do that, then you should sign up for the free Coin Bureau Finance weekly newsletter. We've also curated some finance-related deals for our loyal viewers, which include numerous bonuses, deals, and promotions. So simply click the link in the description below or scan this QR code and it'll take you to our newsletter sign-up and deals page. Okay, now back to the video. Now, of course, governments will never say they're doing anything out of order. But how exactly might the government be stepping out of line here? Well, when it comes to measures of financial surveillance, the press releases talk about fairness, closing loopholes, and modernizing compliance. Okay, sure. But if you're feeling even mildly cynical, you begin to notice a pattern. Once money moves through systems that can be queried and cross-referenced, it becomes irresistible to treat those systems like remote controls. And this isn't just a Venmo thing. A few years ago, there was a serious push for banks to report annual account inflows and outflows to the IRS, sold as a way to catch unreported income. Now, this was presented as high-level summaries, but immediately met with criticism as an overreach of privacy. The details got watered down after some backlash, but the ambition was obvious: more visibility everywhere by default. That is what's known as mission creep. It may start with intentions to target bad actors, but of course you can't reliably target cheaters without collecting data on everyone. Then the threshold becomes a political dial ready for turning. Too loud at $600? Okay, let's try $10,000. Too loud again? delay it, rename it, phase it in, or shift to another reporting channel. The focus here isn't to win every battle. It's to normalize the infrastructure so the next push feels like no big deal and people become complacent. But systems like this are easy to sell to the public. Automated reporting is cheap, audits are expensive, people are expensive, algorithms scale. So, governments lean on systems that already touch the money, banks, platforms, payment rails, to do the sorting and filing. It's outsourcing enforcement to whatever people used because it was convenient. And once that model exists, it doesn't stay confined to one use case. And as this evolves, financial legibility can be a bit like leverage. When people believe everything is visible, behavior changes, even if they've done nothing wrong. Side gigs start feeling like a hassle. Informal favors start feeling like risk. Sending money to the wrong person starts feeling like something you'll have to explain to the platform. Control can be soft. It can be friction, extra steps, verification loops. In a world where your financial life is mostly mediated by apps and compliance, access to the financial system starts to become conditional, and conditional access is a very convenient shape for authority to take. And if this all sounds a bit conspiratorial to you, it's not just us saying this. Regulators have been warning about this for years now. The Consumer Financial Protection Bureau has been sounding the alarm about excessive surveillance in digital payments for years. That's essentially a sign that we're building systems powerful enough to be dangerous, and then hoping they're not abused. Now, whether or not that surveillance system is abused is one thing, but what if the system itself just becomes extremely messy? Well, that's sort of what we've seen so far, and there's no reason to believe it improves significantly from here. Picture this: you sell your old couch online for $700. Not because you're launching a furniture empire, but because you're moving and that couch has seen some things. Fast forward a few weeks and, surprise, surprise, you get a form that looks like it's accusing you of running a furniture cartel. That's one major problem with those 1099-K forms we mentioned earlier. They're built to report gross inflows, not reality. The form doesn't know what you paid for the couch. It doesn't know you originally bought it new, you used it for years, and you sold it for less than you paid because you'd spilt beer on it dozens of times. It doesn't know about fees, refunds, chargebacks, or shipping. It just spits out totals. The IRS points this out in their guidelines. Reports are only gross payments, and you still have to review your records to figure out what's actually taxable. Translation? Congratulations, you've just been promoted to unpaid accountant. And pretty easily, normal life starts looking like income unless you've kept meticulous receipts like a dragon hoarding paper. Even if you sold personal items at a loss, meaning you didn't make any profit, there's no tax liability on that sale. But you might still receive a 1099-K anyway, and then you have to report it in a way that effectively zeroes it out so you don't pay tax you don't owe. Now, add to this the chaos of the real world. Casual sellers, side hustlers, and small operators often mix personal and business transactions in the same app. Sometimes the payer tags it as a purchase by accident. Sometimes it isn't an accident. Sometimes the platform settings changed and you didn't notice. Either way, that's how you end up with an accounting disaster. And as we mentioned, because the IRS also gets a copy, you can't just ignore it. The 1099-K isn't a bill, but if you don't account for those amounts properly, you can trip automated IRS mismatch systems, even when the underlying payments aren't taxable. And when the system thinks your numbers look off, you're the one stuck proving you're not a cheat. And the people who feel this the most aren't the tax wizards or indeed the cheats for that matter. It's the people living in the messy middle, the casual reseller, the weekend freelancer, the small shop that just wanted an easy way to get paid. The compliance net drifts towards anyone whose payments look commercial from 30,000 feet. This is how surveillance feels in practice for everyday people in the modern era. Mundane, time-consuming paperwork that injects significant friction into a system that used to work well. Now, nobody's interested in reading the taco emojis you send your friend when reimbursing them for a meal. That's not the point. The point is that once your money moves through systems that are logged, labeled, and stored, it stops being a payment and becomes a record. A record becomes a dataset, and a dataset becomes something that can be searched, matched, and reused, often in ways that weren't part of the original sales pitch. This is why the payment app reporting drama makes people uneasy even when the threshold gets raised. People aren't really worried that some IRS agent is manually eyeballing their Friday night takeaway. People are worried about the normalization of permanent visibility, where the default becomes you having to clarify and prove your every action and intent. But the pushback against these measures isn't just about privacy or even a tax headache, it's also about security. Yes, collecting more data doesn't just increase government visibility, it also increases the size of the honeypot. But what do we mean by that? Well, more records mean more places for records to leak. The IRS has had very public moments where taxpayer information ended up exposed due to errors. Needless to say, that's exactly what you don't want happening when more people have been dragged into the system, whether they're earning income or just living standard human lives. But there's also a bigger ecosystem problem. Your payments don't exist in a vacuum. They exist in a world where data gets bought, sold, stitched together, and repackaged like it's a harmless commodity. As you've likely seen, there's an entire industry now dedicated to deleting your data held by data brokers. The data broker market is huge, and normal people have basically no visibility into who's holding what about them. And when people claim that data is just used for advertising, sure, until it isn't. The FTC has repeatedly gone after data brokers accused of collecting and selling sensitive location data, information that can reveal where you live, where you worship, where you get medical care, and a lot more besides. The FTC has also alleged that some firms sold or used sensitive location data without meaningful consent, including for commercial and government uses. So, this is what it comes down to. Visibility for one purpose has a habit of becoming visibility for other purposes too, because the infrastructure is already there. And if you doubt that governments have an appetite for more access, look at the recurring battles over encrypted data. For example, in early 2025, the UK ordered Apple to enable access to encrypted cloud backups of users. In many cases, once these libraries of data have been built up, governmental bodies worldwide have demonstrated that they're happy to let private businesses leverage them to the hilt. That is, when governments themselves aren't leaking your data to nefarious actors due to a lack of security. Now, with all of that said, one question remains. Is building these reporting systems actually worth it for governments if it comes with mountains of errors and costly data leaks? Well, even if you take the official argument at face value, the answer is still a strong yes. The IRS says there is a massive tax gap. That's the difference between what's owed and what's paid. For tax year 2022, the IRS estimated an annual gross tax gap of just under $700 billion. So, any tool that helps the government go after that money seems highly valuable. And just to be clear, this push isn't uniquely American. The OECD's so-called model rules urge platforms to collect and report seller income. The European Union's DAC7 expands cross-border reporting without creating new taxes. These measures even reach into the cryptosphere, where reporting frameworks in most major countries now require exchanges to share detailed transaction data. So, that's the drift. Systems apparently designed for compliance become the default architecture of money and our global economy. And that drift is speeding up worldwide. But back to the US for a moment. In the House report on the Saving Gig Economy Taxpayers Act, they cite an estimate saying that going back to the $20,000 reporting threshold would mean about $10 billion less revenue over 2025 to 2034. That would be around $1 billion a year. Now, $1 billion isn't nothing. But next to that $700 billion annual tax gap the IRS outlined, it's chicken feed. So the real question here becomes, what are governments gaining with the extra visibility, and what are the public normalizing? The precedent is the scary part. Once payment surveillance becomes integrated into how payment apps of all kinds work, it's easier to widen the net later. If the goal is revenue, fine, but what's the limit? And what guardrails exist so tax compliance doesn't become financial permissioning? A system where spending is legible by default is a structure where control is always just one policy tweak away. So, not exactly a pretty picture with freedom as a core pillar of society. Perhaps we'd better enjoy it while it's still standing. And well, that's our take on the ever-growing government impulse towards financial surveillance. But what do you think? Will these systems eventually report everything by default, or will high thresholds remain the standard? Let us know your thoughts down in the comments. And if you want to find out what 2026 has in store according to the biggest asset manager in the world, then check out this video over here. That's all from me for now though. As always, thank you for watching and I'll see you next time. This is Guy, signing off.